Hey everyone, welcome back to the channel, your number one source for income-oriented investing. In today's video, I want to take a look at some really good and nice opportunities there are right now in the split shares, especially I'm going to focus on the Class A shares. So as you know, split shares have been discussed many times on this channel. I'm going to try not to go into, explaining how they work because it'll be a 3-hour video. But if I could just maybe summarize in 60 seconds with the help of Brompton, who's sponsoring this video, by the way. I'd like to thank them for me being a good friend of the channel, and Brompton is one of the biggest providers of split share funds in Canada. So we're going to really focus on Class A shares because there's some great opportunities with the split share Class A shares. But what are split share funds? Well, if we look at a very good, important article that Brompton came out with just a few weeks ago in late January 2024, and you could read this, I strongly suggest it, but I've highlighted the part where it kind of tries to summarize what these funds or what they are. Essentially, they are corporations. They're closed-end funds, a little bit more on that later, but basically it's called a split because there's actually two separate stock symbols for this one corporation, you could say. So that's why it's called the split corp. So there's the preferred shares, and then there's the Class A shares, which is what we're going to be focusing on. So why do they split it? Why is there two distinct stock symbols? Well, like it says here, the preferred shares receive regular dividends and have a fixed term to maturity. Investors in the preferred shares have priority claim on the repayment of the par value of the shares at maturity, and they do not participate. Here's the key. Do not participate in the capital gains generated in the portfolio. So basically the preferred share of a split fund, very boring, very stable, just like regular preferred shares, right? Like Enbridge and Bell, they actually have preferred shares. There's the regular shares, ENB, but then there's, like ENB for Enbridge and BC or whatever the Bell stock symbol is. And then there's the preferred shares, different stock symbol. They tend to be, they tend to have really good dividend and be very stable. That's their point. It's more kind of like a bond, right? So that's the preferred share. The Class A share, in my opinion, is what's most exciting because, like it says here, they provide investors with enhanced returns. So higher and improved upside during bull markets, but we have to be honest, accentuated downside or more downside during down markets. And that is because of the leverage effect. So because of how the split happens, all the movement of the stock prices of the portfolio goes to the Class A share. So that's where that leverage effect comes in. It's not borrowed money. It's just synthetic leverage because of the way that the split share fund is set up here. So basically you get more upside during a bull market, more downside during a down market. That goes with anything where you put leveraged on, right? So just to continue as well, and continuing on the Class A shares, as well as the opportunity to receive high monthly cash distribution. So this structure has allowed the Class A shares to generate long-term outperformance in equity markets that have historically trended higher over time. So split corps generally invest in large cap dividend paying stocks. So in short, guys, the Class A shares, when you're buying them, it's kind of like a leveraged investment in a portfolio of very high quality stocks. That's basically it. And it's not leverage you're taking yourself. It's not borrowed money. The fund manager is not using borrowed money. It's just synthetic leverage in the fund. So I go over more of this in detail. I even talked to the two main people at Brompton, Chris Cullen and Michelle Tiraborelli, about split share funds in general for over 40 minutes in another video. So if you want to learn more about split share funds, you're maybe new to them, I know it's it's more complicated fund to understand compared to ETFs. I strongly recommend this video here where we talk a lot about, how these funds work and their history, the dividends relating to them, how leverage works. Strongly recommended. But going back to where there's some great opportunities. So this is really where I want to focus on in this video here. There is a lot of opportunity right now pertaining to the Class A shares. So we're going to take a look at a few of them here. So one thing it's important to remember is that these are closed-end funds. So there's a set number of shares. Why is that important? Well, that means that basically the current stock price or the market price, so when you put the stock symbol in Google or wherever stock search provider you use, you will see the stock price. But then there's the net asset value. So the net asset value, and by the way, ETFs have this as well. They have a stock price and there's a net asset value. But because ETFs are open-ended funds, the net asset value and the market price are typically very, very close or almost the same. But with closed-end funds, they could diverge. So you could have a fund that basically the net asset value or its actual intrinsic value is much higher than the current stock price. That would mean that the fund is trading at a discount, right? If the net asset value, for example, and we'll take a live example here of one that is trading at a discount. For example, LCS, the net asset value, how much this fund is actually worth is $7.34 a share. But the current market price, and this is all prices, by the way, on February the 15th, Brompton updates most of their split share funds every Friday. And when I say update, I mean the net asset value. So you see here the NAV date is as of February the 15th. I'm actually filming this on the 16th. But for example, if we look at LCS, right, which is the Brompton Lifeco Split Corp, which has 4 of the biggest life insurance companies in Canada. So Sun Life, Manulife, Great-West Life, and IA Financial are the 4 stocks in this fund. And right now the fund is worth $7.34 a share, but you could buy it for $7.05 a share. So this is a split share fund trading at a discount. Same thing for PWI, which contains quite a bit of, big, large portfolio of sustainable power infrastructure stocks. So, more boring stocks, more defensive stocks like utilities and things like that. Net asset value, $6.86. What is it actually worth? That's what it's actually worth. What can you buy it for? Right now, $6.59. So it's very easy to actually calculate the discount percentage just using a nifty calculator. Very easy, guys. All you have to do is take the stock price or the market price. So let's do LCS. So 7.05 divided by the net asset value, which is 734, minus 1 times 100. If you do that, you will get the discount percentage. So right now, LCS is trading as of February 15th price, 3.95% discount. So you're getting literally 3.95 or 3.95% discount. So it's almost like buying $1 for 96 cents almost, right? So that's what it means. We could do the same thing for PWI. If you do 6.59 divided by 6.86, and of course you could do it using the updated stock price of the day. Same thing, minus 1 times 100. This one is trading at a 3.93% discount. So that's what it means when it's literally trading at a discount. So the intrinsic value, the NAV, is actually higher than what you could buy it for. So that's actually pretty rare. And not all of them are trading at discounts. LCS and PWI are. The other ones are not. Well, actually, DGS is trading at a tiny, tiny discount because you see here stock price $5.49, but it's valued at $5.52. So that's a tiny, tiny discount. So why is that important? Why is there a lot of opportunity? Well, it's because since these are leveraged investments in a portfolio of high quality stocks, when the markets go up, these investments will go up more because there's more of an upside effect. So the proof is in the pudding. If we just go back to this document here, you could see that they actually compare some of their more popular Class A share or split share funds. And split share funds have been around for a really long time. This is 10 years of data. So you see here that LCS, the life insurance one, the one that focuses on life insurance, this would be this one here, LCS. If we look at the portfolio, this is invests in 4 companies, life insurance companies, Manulife, Great-West Life, Sun Life, IA Financial. That's what this fund invests in. And for example, if we go back here and check, you see that LCS is outperforming this index, the S&P TSX Cap Financial Index. SBC is another split share fund here that invests mostly in the 6 banks. Also, 90% of this fund is in the big 6 Canadian banks. And then you have LBS, which is Brompton's biggest split share fund, invests in the top 10, in the big 6 Canadian banks and 4 life insurance companies. And you see that over the past 10 years, they've all outperformed. This is the Class A shares. This index here, which is basically tracking the financials aspect of the TSX or the Canadian stock market, the financial stock. It's really, really interesting. It's a great opportunity, especially for LCS, but even LBS, if we go back to LBS here, it is trading at a small premium, but and we could calculate it very easily. You do 7.69, that's right, the closing price, divided by the NAV, which is 742, minus 1 times 100. And it is trading at a 3.63% premium. That's a very, very, very small premium. And one thing that I discussed with the two main people at Brompton, Michelle and Chris, and they were kind enough to show us graphs or anything. A lot of split funds, most of the time, they trade at premium. So it's very, very rare to have them trade at discount. So this is why it's a great opportunity. Even if LBS, for example, is trading at a premium, it's very, very rare to do so. So just going back to the sheet here, you also have these are financials focused. That's why they're gonna compare it really to the financials index. But you also have DGS. So DGS is their second biggest split share fund, which is kind of like the overall or some of the best dividend stocks in Canada. So this is also a very interesting one. It's called Dividend Split Corp. If you look at the portfolio, guys, you'll see that it's a very, very well diversified within Canada mostly. There is 9.5% in a global dividend growth ETF, which is great, but the majority of this portfolio is going to be in Canadian dividend stocks. You will recognize a lot of them. Very, very well diversified as well. You see the breakdown here. Of course, it's going to have a lot of financials, a lot of energy. That's just the Canadian market has a lot in those sectors, but a really nice mishmash of the best dividend growth stocks in Canada. And if you look at this here over a 10-year period, DGS is outperforming the S&P TSX Composite High Dividend Index, right? You got to think long term. So it's a great opportunity also for DGS because like we discussed in that video, 80% of the time, DGS trades at a premium. Right now, it's trading at a tiny, tiny discount. So it's an amazing opportunity. So really cool opportunity with a lot of these Class A split share funds here. I mean, you could choose whichever one you like the most because you gotta, obviously you're investing in the stocks in the portfolio. So just to recap here, LCS, top 4 life insurance companies in Canada. This one is actually trading at a discount. Fantastic opportunity. PWI, if you like sustainable power infrastructure stocks, this one is actually trading at a discount as well. It's pretty cool. If you look at the portfolio of stocks, these, first of all, it's global. You have the region here, but you're going to have a lot of utilities, energy, materials, industrial stocks, a lot of real assets and infrastructure stocks. You'll recognize quite a few of them here. You'll see that here. These are, typically boring stocks, which is the point. These are real assets and infrastructure stocks. So PWI also a great opportunity to pick it up because it is trading at a discount. But there's also some financials one. There's LBS, there's SBC. LBS especially, good time to pick it up. You have the LBSs here, which is, you could say the big six Canadian banks, guys, with Manulife, Great-West Life, IE Financial, and the other one that I missed, Sun Life, Manulife, Great-West Life, IE Financial, and the big 6 Canadian banks. That's very, very, good quality financial stocks. And let's start with DGS, guys. Very, very popular, very humongous fund, second biggest split share fund from Brompton. So DGS, Dividend Growth Split Corp, is basically the top-notch Canadian dividend growth stock. So what can we compare it to? Well, it's pretty simple, just like their document here, they're comparing it to the S&P TSX Composite High Dividend Index, right? Which is this index right here, which is basically an index that has Canadian dividend stocks, high dividend stocks, right? So if we actually look at index-linked products, an ETF from BlackRock, very, very popular. I know many of you are gonna know this ETF, XEI, is actually tracking or trying to replicate this index, right? It's this ETF right here. So if we actually do a comparison of DGS versus XEI, a total return comparison over time, you'll see that DGS is outperforming, right? XEI, you could clearly see the average annual total return since, and we're going back a while, we're going back since 2012. So this is 12 years of data. You see DGS on an average annual total return basis is outperforming XEI. And you can clearly see when the leverage really has a good effect. It's during the bull markets, right? So you could see this is a bull market, right? Because it's going up. DGS will go up much quicker than an XEI because of that leverage effect. Same thing here. Look at this massive upside during a bull market. But of course, there's going to be more downside during a bear market with leverage, right? So if you're a long-term investor, guys, you don't mind a little bit more risk or volatility because of that leverage, you want to invest in the top Canadian dividend growth stocks. DGS could be a really good long-term investment. You put it in your investing account, you put the drip on, and this is a fantastic total return or growth is investment over time, right? So another one would be, I know what you're saying, XEI is great, it's fine, but I love VDY. And to be honest with you, VDY is really the one to beat. It is outperforming XEI a little bit. It's very similar stocks, but it's based on a different index, very similar index. The MER is the same. So how does DGS compare to VDY, which is really the one to beat in my opinion? Well, guess what, guys? It's outperforming VDY as well, right? So this is why you can't just ignore split share funds just because you don't understand them or there's a lot of negativity around them. You really have to understand how these funds work. So I just wanted to show you how DGS actually compares to similar funds that hold similar stocks. It does really, really well over the long term, right? So that's DGS, which is really a mixed bag of all sectors within Canada. Let's take a look at things like the financial specific ones, right? Like LBS, LCS, and SBC, because from this document, they also outperform this index here, which, by the way, I found the index for you guys. It would be this index, right? The S&P TSX capped financials. And of course, there's a BlackRock ETF called XFN, which tries to seek or replicate the exact same index, which is XFN. So, for example, if we do XFN versus LBS, which is the biggest and most popular split share fund from Brompton, you'll also see LBS outperforming the index over time, right? And it's by quite a big margin. You see that here, especially when the bull market, especially when there's a big upswing, you kind of see LBS just boom and just out of the gate, right? So your $10,000 would become 45 now in LBS and only 34 if you would invest in XFN in this ETF here. And the story is the same, by the way, for the other financials one, right? LCS, SBC as well, just like this document says here. They are outperforming, LBS being the biggest outperformer compared to that index. So again, I want to thank Brompton for sponsoring this video. And again, guys, these could be some really great investments if you don't mind a bit of leverage, a little bit more volatility for the long term. They're all very, very quality stocks. And this brings me to the last one I want to discuss. This is my personal favorite split share fund. It's GDV, the Global Dividend Growth Split Corp. Here it is. This one has the best dividend stocks, growth stocks, all around the world. So unlike DGS, which is focused on Canada, and the financials one, which are only focused on financials, this is really super diversified. This is not only diversified globally, of course, the majority is going to be United States. That's just where the best stocks are, but also sector-wise. So if you want the best global dividend stocks, GDV could be a phenomenal, you'll recognize a lot of stocks. These are all high quality blue chip stocks. GDV could also be a great investment for you. I personally own GDV. I have $60,000 of my own money in here. So these investments, in short, guys, they're great for long-term total return and growth. I just wanted to make this video today because just like Brompton came out with this, they didn't just come out with this article for no reason. There is some great opportunity with the Class A shares, especially because of that whole premium discount dynamic. And literally some of them are trading at discounts, and some like GDV, LBS, and DGS are very, very close or on par. And it's important to understand, yes, but Adrian, you might be asking, why would I get GDV or LBS when it's trading at a small premium? Well, I recommend you watch this video because Brompton shares a lot of data. But basically, these investments, for a majority of the time, typically, they trade at big premiums. For example, GDV, I've been watching it for quite a few years. I've seen GDV trade at 20-25% premium, guys. Now it's only trading at 3%. So it still is a great opportunity. It's a leveraged, great investment in high quality stocks. So you could check them out on the website, guys. I'll put the links in the video description below. Again, I didn't want to try to go too much into explaining how these investments work. They are a little bit more complicated, but I have other videos for that, especially this one. This is an important one I want you to check out. If you're interested in these funds, you want to learn more about them, you got to learn exactly how they work. But in short, an investment in a Class A share of a split share fund, it's a leveraged investment in a portfolio of very, very high quality stocks, typically dividend stocks, right? So you got, again, to recap, DGS is Canadian dividend stocks, GDV global dividend stocks, and then you have the LBS SBC and LCS, which focuses more in the financial sector in Canada. You also have PWY, which focuses in sustainable power and infrastructure. So if you like any of these sectors, this is a great, and you don't mind a bit of leverage, you want that, you don't mind volatility, you're a long-term investor, split share Class A shares. Like we saw in the performance comparisons, right, to these really hard and heavy hitting funds, can be a great total return proposition for the long term. So that's it for this video, guys. If you have any questions, let me know. And again, check out this video if you want to learn more about split share funds. I highly recommend it. So thank you and see you next time.